So, this past week in the stock market, huh?
Yep.
It's definitely been one for the books.
Absolutely.
Not exactly the kind you want to reread, I'd say.
Right.
And I don't know about you, but I've definitely been kind of glued to the, watching those numbers drop.
For sure.
And, maybe feeling just a little bit of that knot in the stomach
Yeah.
when you see your investments kind of,
Yeah.
taking a hit.
It can be unsettling for sure.
Yeah. So that's exactly what we're going to be, digging into today.
We're going to be cutting through all the noise,
Right.
all the headlines
Exactly.
surrounding this recent market downturn.
Yeah.
And
I mean,
they're calling it the worst week since 2020,
oh, yeah.
which is a period I think a lot of us
Physically.
vividly remember.
Yeah.
But we've gathered some really interesting analysis
Okay.
from top market professionals
Great.
who can help us understand not just what happened, but more importantly, what it could mean for you.
Yeah.
And,
How to navigate.
exactly how to navigate these waters.
Yeah. And when they say worst week since 2020, I mean, we're talking some pretty serious numbers here.
Absolutely.
The Dow Jones Industrial Average.
Oh, yeah.
It took a huge hit,
It did.
plummeting over 2,200 points on Friday alone.
It's a big drop.
It is.
And then you've got the Nasdaq, the more tech-heavy index,
Right.
officially entered a bear market,
Oh, wow.
which means it's fallen 20% or more
Yeah.
from its recent high.
Okay.
Which really signals a
Yeah.
significant and sustained downturn.
Yeah. That's when you gotta, pay attention.
You got to pay attention.
And then, of course, the S&P 500,
Yeah.
not spared either,
Not at all.
shedding almost 6% on Friday.
Yeah.
So just to kind of put that in perspective,
Yeah.
we're talking about over $5 trillion
Wow.
in market capitalization.
5 trillion.
Just poof, gone
That's a lot of money.
in a couple of days.
Yeah. And it's enough to make anyone, reach for that panic button.
Yeah. And I think that's the,
It's a natural reaction.
it is.
It's a very human thing to want to kind of
Right.
react strongly and make changes,
Yeah. When you see those numbers.
especially when you see your own portfolio, taking a hit.
Yeah.
Your brain is wired to respond to threats.
Oh, yeah, for sure.
But I think before we do anything rash,
Okay.
let's just take a breath and really understand
Right.
what sparked this sell-off.
Right. So let's unpack that a little bit.
Yeah.
Looking at our sources, it seems like the primary catalyst here was President Donald Trump's trade war.
That seems to be the consensus
Yeah.
among the analysts we've looked at.
Yeah. It seems that this reignited fears.
Yeah, about global economic growth,
Right.
corporate earnings.
Right.
And that's what kind of triggered this broad market sell-off.
Right. And it's interesting because they point out that no single sector within the S&P 500 was immune to this.
Right.
So, it wasn't just tech stocks or energy companies feeling the pinch.
Yeah.
This was widespread.
It was a broad wave of concern.
Yeah. It really makes you wonder.
Yeah, what's the market trying to tell us here?
Right. What are they collectively processing?
It's almost like they're all taking a pause,
Okay.
stepping back to reassess the situation.
Yeah.
They're trying to understand what this trade war could really mean long term.
Right.
And then adjust their strategies.
So that's where I think the insights from these seasoned market professionals become really critical.
Absolutely.
Yeah.
Because they've seen it all before. They've weathered these storms.
Exactly.
And they have some really valuable advice for all of us.
Okay, so let's dive into that advice.
Okay.
The first piece of advice that seems to be echoing across the board
Yeah.
is something we've all heard before, but it bears repeating, especially now.
Especially now.
Don't panic.
Don't panic.
I mean, it sounds so simple, right?
It does.
But when you're actually watching
Yeah.
the value of your investments decline, it's incredibly tempting to just want to pull everything out.
Right.
Cut your losses and run.
It's that fight or flight response.
Exactly. Yeah, but Gina Bolvin from Bolvin Wealth Management Group,
Yeah. She's a smart lady.
yeah, she's very direct on this point,
She is.
saying don't panic the headlines
Yeah.
and the market, they change quickly.
That's the key. They change quickly.
So how should we be thinking about, this urge to react?
Well, you have to remember that we as humans,
Okay.
we're naturally loss averse.
Okay.
meaning the pain of a loss feels much stronger
Yeah.
than the pleasure of an equivalent gain.
Interesting.
So when we see those losses,
Yeah.
it can really trigger
Yeah.
some emotional decision-making,
Yeah.
like selling low out of fear.
Right. Just getting out.
Exactly.
Complete.
But Gina's absolutely right.
Yeah.
Market downturns, even sharp ones,
Uh-huh.
are often followed by recoveries
Okay.
and trying to time the market perfectly. Trying to buy at the absolute bottom and sell at the absolute top.
Yeah.
It's a fool's errand.
It is.
Even for the most experienced traders.
Yeah.
You know, if you're investing for the long term,
Mm-hmm.
especially for goals like retirement,
Right.
which are years or even decades away,
Yeah.
these short-term fluctuations,
Okay.
while unsettling, they're just part of the journey.
Okay.
You have to view them within that broader time frame.
Right.
And historically, the stock market has trended upwards over the long run.
Right. It's like being on a roller coaster.
Yeah, a little bit,
There are going to be ups and downs.
for sure.
But overall, the journey is,
Hopefully upwards.
hopefully in the right direction.
Yeah.
So the reports also talk about this idea of safe havens
Yes.
during these periods of market volatility. And this is where we get into this distinction
Yeah.
between cyclical and defensive stocks.
Okay.
Can you break that down for us?
Sure. So cyclical stocks are companies whose performance is very closely tied to the overall economic cycle.
Okay.
So when the economy is booming,
Yeah.
consumer confidence is high,
Right.
these companies tend to thrive.
Oh.
Things like, high-end retailers or
Sure.
leisure and entertainment companies.
Okay.
Things that people might splurge on.
Right. When they have the little extra cash.
Exactly.
Okay.
And given all the concerns about the economy,
Yeah.
this sector has taken a hit this year.
Yeah. How much of a hit are we talking?
About 17%.
Wow.
Yeah.
Okay.
On the flip side, you have defensive stocks.
Okay.
These are companies that tend to be more resilient,
Okay.
regardless of whether the economy is strong or weak,
Okay.
because people still need these essential goods and services.
Right. They always got to eat.
Exactly. They always got to eat.
Right.
They need household products, healthcare, those kinds of things.
Okay.
So the consumer staples sector is a prime example here.
Okay.
And what's really interesting is that this sector is actually up for the year,
Wow.
even after this recent sell-off.
Oh, that's a big difference.
It is a big difference.
Down 17% for consumer discretionary,
Right.
and then an increase for consumer staples.
Yeah, it really highlights how differently
Yeah.
these sectors can behave.
Okay, so beyond these specific sectors,
Yeah.
what other types of assets
Mm.
are typically considered safe havens?
So traditionally, things like gold
Okay.
and U.S. Treasury bonds,
Okay.
these are seen as kind of the go-to safe havens
Oh.
in times of economic uncertainty,
Uh,
market turmoil.
okay.
Investors often flock to these assets.
Did he do? Okay.
Yeah, because they're perceived as being more stable.
So if you're an individual investor,
Yeah,
how easy is it to actually get exposure to these safe havens?
it's actually pretty straightforward.
Okay.
You can invest in exchange-traded funds or ETFs.
Oh, okay. ETFs, I've heard of those.
Yeah, so these are basically baskets of stocks or bonds
Okay.
that track a specific index or sector.
Got it.
So it's a really easy way to get diversified exposure
Okay.
to gold or treasuries.
Okay, so, and this kind of goes back to what Gina Bolvin was saying
Exactly.
about, maybe not making drastic changes to your portfolio during these times,
Right.
but rather making sure it's already well diversified.
Exactly, because when you're diversified,
Yeah.
you're not putting all your eggs in one basket.
It's that classic saying.
It is a classic saying.
So one thing I think a lot of people might be tempted to do
Yeah.
when they see this kind of volatility
Uh-huh.
is to try and actively trade,
Right.
buy low, sell high,
Uh-huh.
maybe even try and time the market.
Yeah.
What do the professionals say about that?
It's tempting,
It is.
especially when you see a lot of movement,
Right.
but the overwhelming consensus is to be very cautious.
Okay.
Day trading is incredibly difficult,
Right.
even for professionals.
Yeah.
And the vast majority of people who try to day trade
Uh-huh.
end up losing money.
Oh, wow.
Yeah.
So,
The transaction costs add up, and it's just so hard to consistently predict
yeah.
short-term market movements.
So for most of us, trying to become a day trader overnight is probably not the best idea.
Yeah, I would say probably not.
It might sound exciting,
It does.
but
It's risky.
yeah.
You're more likely to lose money than to make money.
So the advice seems to be
Yeah.
resist that urge
Yes.
to constantly buy and sell. based on, these short-term blips.
Oh, short-term noise.
Yeah, and instead stick with a well-thought-out,
Exactly.
long-term investment strategy.
Yeah.
It might not be as exciting,
It's not as glamorous.
but it's generally considered a much more prudent approach
Absolutely.
to building wealth over time.
Yeah, for the vast majority of investors.
Okay.
Trying to outsmart the market in the short run.
Yeah.
It's just not a winning strategy.
So we've talked about not panicking.
Right.
We've talked about diversification,
Mm-hmm.
steering clear of impulsive trading.
Yes.
The last key piece of advice
Okay.
that keeps coming up
Yeah.
in these reports is about having adequate cash reserves.
Oh, this is so important.
It is. It is.
And, it serves a really important dual purpose.
Okay.
So first and foremost,
Yeah.
having that readily accessible emergency fund,
Okay.
whether it's in cash or highly liquid cash equivalents.
Like money market funds.
Yeah, exactly.
Okay.
Provides a critical safety net
Okay.
for unexpected expenses.
Right. So if you lose your job,
Yeah.
medical emergency,
Mm-hmm.
major home repair,
Yeah,
you've got that cushion.
exactly. You don't have to panic.
Okay.
You don't have to make rash decisions
Yeah.
with your investments.
Okay.
And secondly,
Yeah.
having cash during a market downturn
Okay.
can actually give you an opportunity
Okay.
to buy investments at a discount.
Oh, okay.
You're essentially taking advantage
Yeah.
of that market dip.
Right, right. Buying low.
Exactly.
So it's about protecting your downside,
Yes.
but also potentially,
Taking advantage of opportunities.
taking advantage of opportunities down the road.
Yeah.
So what about how much cash should people actually have?
Well, the analysis we looked at
Yeah.
actually offers some specific guidelines here.
Okay.
Brett Panziera from EP Wealth Advisors suggests having at least 6 months
Okay.
worth of your regular living expenses
Okay.
in cash or cash equivalents.
6 months.
At least 6 months.
Okay.
And for those who are retired,
Yeah.
no longer have employment income,
Yeah.
he actually recommends 2 to 3 years
Wow.
worth of expenses.
That's
It sounds like a lot,
it does sound like a lot.
but it really underscores the importance
Yeah.
of financial resilience.
Yeah.
Having that buffer
Yeah.
can give you tremendous peace of mind
Right.
and prevent you from having to make,
Yeah.
tough decisions
Right.
about selling your long-term investment.
Right. At a bad time.
Exactly.
So let's bring it all together
Okay.
for our listeners out there. As you're navigating this period of market uncertainty, the key takeaways here are, first and foremost,
Don't panic.
don't panic.
Don't make rash decisions
Right.
based on the headlines
Right.
or short-term market moves.
Understand how different sectors
Yes.
and asset classes tend to behave during these volatile times,
Yeah.
and make sure your portfolio is diversified.
Absolutely. Diversification is key.
It is. And then, of course, steer clear of that temptation to try and time the market.
Yeah. Active trading can be very dangerous,
Yes.
especially for non-professionals.
And finally, make sure you have a comfortable buffer of cash.
Yes. That emergency fund is crucial.
To protect yourself from those unexpected events.
Yeah. And to take advantage of future opportunities.
Right. So while it's totally understandable to feel a little unsettled,
Absolutely.
maybe even a bit frightened.
Yeah. When you see these big drops,
Right.
it's important to remember that historically, the stock market has trended upwards over the long term.
Yeah.
These periods of volatility, they're a normal part of the cycle.
Right. So as you're processing all of this, here's a question for you to think about.
Okay.
Take a moment and just honestly assess your own financial situation. How well diversified is your portfolio?
Yeah. Is it aligned with your goals?
Does it match your risk tolerance?
And how about your cash reserves?
Yeah.
Do you have enough to weather the storm?
To sleep well at night.
Exactly.
These are the kinds of reflections that can empower you to navigate these uncertain times with greater confidence and a more informed perspective.
For sure.
Thanks for joining us for this deep dive.
Thanks, everyone.